Hi guys, another Monday, Knowledge Monday. Okay, my name is Lydia Tetolet and I work for insurance company. I've been doing insurance for 5 years and I work for a company called Precise Protect. So www.preciseprotect.co.uk. You can check them out. And Precise Protect, we are actually governed and regulated by FCA. FCA is the same body that regulates the banks. So you are safe, okay, if you take insurance with us. And under Precise Protect is just an umbrella. And under the Precise Protect, we also work for all the companies in the UK, all the good ones. Okay, there are some scam insurance companies out there, but we, as Precise Protect, we only work with the best companies and genuine companies in the UK. But as much as they are genuine, if you take insurance, and insurance now is time to claim, and that's when some people say, oh, insurance has scam, insurance don't want to pay. Insurance is not a scam. Now, let me tell you how it works. If you don't disclose anything, and sometimes when you're taking insurance, they're not going to ask you so many questions, but when you want to claim, they're going to check all these questions. So you make sure that you disclose everything. That's why it's very, very important to take insurance with somebody that you really trust and somebody who actually knows what they are doing. Okay, and that person, for now, it's me. Anyway, we have so many very, very good advisors out there. But now, today, I just want to talk about inheritance tax. The 40% inheritance tax. There's a lot of people who don't even know about inheritance tax. Because some mortgage providers are not going to educate you about inheritance tax because they think that you should know that. They're not going to educate you about insurance. They're not going to educate you about life insurance attached to your mortgage or critical illness attached to your mortgage. Now, critical illness is always very, very expensive. Why? Because it's been proven that 20 years from now, more people are going to suffer critical illness and claim on critical illness than life. Okay? So, that is why critical illness is always so expensive. But guys, what's the point of having a mortgage that you are paying whatever your mortgage is 200,000 or 300 or 5, whatever your mortgage is, and you can't afford to have insurance in place for critical illness or for life cover? That means that if you are diagnosed with a critical illness, God forbid, and critical illness are things like from stage 2 cancer, stage 1 is not critical, from stage 2 heart attack, stroke, MS, kidney failure, liver failure, you've had an accident and your leg or your hand have been amputated. So you can go and Google out what are the critical illnesses, okay? What are termed as critical illnesses? Some providers have more, some providers have less. But even the ones that have more, sometimes it's one thing and they've defined it in so many ways. So you think like, oh my God, this company actually covers 100 critical illnesses and this other one only covers 40. Sometimes if you check, it's just one word defined in so many different names, but it's only one. So that is critical illness. So my advice would be, if you can actually afford to have a mortgage, you can afford to pay your critical illness and to pay your life cover. Because if you passed on that house, if you've not finished paying for it, they're going to take your house, because who is going to pay for the mortgage? Now, if you've been diagnosed with a critical illness, who's going to pay? Now you can't work because you have a critical illness. The shock, just the shock, first of all, that you have a critical illness. All this is, how are you going to pay your mortgage? Okay, so it's very, very important to have your life cover and your critical illness attached to your mortgage. And it's in a decreasing term. So if you have a mortgage provider or you're looking for an advisor, it's in a decreasing term. So it's not going to be very, very expensive than a normal insurance. So there are two. The normal insurance, which is a level, and there's also a decreasing insurance, which is attached to your mortgage. Now, let's talk about the inheritance tax that I know a lot of people don't even know about. If you have a property, or if you have an estate, and your estate is more than the threshold of 325, I think, yeah, 300. Your estate is more than 325,000 pounds threshold. You are liable to pay the 40% inheritance tax. Now, so many people don't even know about that. I talk to people and I ask them, do you know about what? What is that? I don't know. My mortgage provider didn't tell me. Guys, we should not live in ignorance. We should not live in, I didn't know, because what they say is ignorance is not an excuse of breaking the law. Ignorance is not an excuse of getting away with anything, getting away with murder, getting away with ignorance. You cannot just leave and say, I didn't know. So if you're going to get a mortgage, first of all, find out what is attached to this mortgage. What is going to happen if I was to pass on? What is going to happen if I'm to pass on this mortgage as a gift to my children? You have to pay 40% inheritance tax. If this is more than the 325, which is the threshold. If it's under that, that's fine. But don't forget that they're going to put all your estate together. If they put all your estate together, they take out all their liabilities. If your asset now, after they've taken their liability, is more than 325, you are liable for a 40% inheritance tax. If you don't have this, let's just say your mortgage is mortgage free. You finish paying your mortgage. Hooray! Now you've passed on. Your children still have to pay the 40% inheritance tax. Now, if you want to dodge that and say, oh, I don't want to pay the inheritance tax, so I'm going to give my children this house, my house, as a gift before I pass on. Good. But you must live. There's something called 7 years rules, inheritance tax rules. You must live in that property for more than 7 years. Now, more than 7 years, you can now gift it to your children or your friends or your family, whoever you want to gift it to. And you'll avoid paying the 40% inheritance tax, even if you are to pass on. Okay? Now, if you live in that property more than 3 years and you want to give it as a gift, you have to pay the 40% tax, inheritance tax. If you live for 3 to 4 years, it's 32%. If you live for 4 to 5, it's 24%. If you live to 5 to 6, it's 16%. 6 to 7 is 8%. 7 and over is 0%. So you're not paying any inheritance tax. But there's also a catch. If you give this as a gift, and then you're still living in that property, you're still liable for 40% tax, because that means that you've just partly gifted it out. You've not really gifted it out. So you're still, if you're living in that property, you're still liable for the 40%. Because I know I've spoken to some people and they're like, oh, I'll just give my children, but I'll stay there. You're staying there. So you're still liable unless you pay them, you're paying the rent to the new owner for still, it has to be still 7 years. That's the only way you're going to be exempt. Okay, so you still have to pay the rent. Even if you're living in that house, you still have to pay the rent for 7 years. Otherwise, you're still going to pay for the inheritance tax. So guys, these are things that you should know about inheritance tax. These are things that we have assets out there. We have a lot of assets. By the time they put all the assets together, it's more than 325 threshold. And then, boom, you have to pay for inheritance tax. So if you don't want to gift it out, take insurance. And when you're paying the inheritance tax, is it the value of the property when you acquired it? Or is it the value of the property when you've passed on? It is the value of the property when you've passed on. So if your property was, let's say 250,000 when you acquired it, and now you've passed on and your property is, what did I say, 350? Yeah, 250. Okay, let me do a math that I'll remember. If your property is 250 when you acquired it, at that time, you're still not liable for inheritance tax. But when you pass on, your property is 500,000. Okay, so now what they do, they minus the 500,000, minus the 250, and they minus the 500,000 minus the 325,000, which is the threshold, and then the remaining balance, you still have to pay the 40% inheritance tax from it. Or they put all your assets together, your assets total to 1 million, 500,000, 600,000. They just deduct that. They deduct the 325 and you pay the balance, 40%. Now, here comes that you've passed on. Your property is more than the threshold of 325,000. And you don't have the 40, your children don't have the 40% inheritance tax to pay. What happens? They'll take the house away. Even though you're rent free, you finish your mortgage free, you finish paying for your mortgage, it doesn't matter. So guys, today, Monday, is about educating you in inheritance tax. You can also go on Google and try and Google out your situation and the 40% inheritance tax that you will pay in your assets. Go and educate yourself. And even if you have to look for loopholes that you're going to avoid this tax, look for it. But it has to be legit, because there is legit ways. Like I say, the seven years rule to avoid inheritance tax, it's there. So that one as well, you can do that. But what I can tell you guys, to be honest, 100%, inheritance tax is very important. You're going to pay for it. There's no escaping that. And now imagine your house being taken away because your children can't afford the 40% inheritance tax when you've passed on. And you're happy thinking, I have a mortgage. But do you really have a mortgage? Okay. And also you have a mortgage and you don't have insurance attached to your mortgage. You don't have life insurance attached to your mortgage. You don't have critical illness attached to your mortgage. And if that was to happen, and then with the inheritance tax as well, you can actually get an extra cover for insurance that will cover that 40% if you're to pass on. The only thing is, we don't know when you're going to pass on. So you don't know when you pass on how much the value of that property will be. But you can just assume and say, okay, my mortgage is 20 years from now. Maybe in 20 years from now, my house will be worth A, B, C, D. So just take something to cover that. And guys, like I always say, people say, or I don't want to talk about insurance because if I talk about insurance, I'm going to die, blah, 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 blah. Let me tell you something. Like I always say, insurance people are praying for you not to die because they don't want to pay. So you have so many people praying for you. So if you're somebody who loves people praying for you, take insurance. I'll see you next week on Monday when you're going to talk about trust fund. If you have trust fund, you'll avoid to pay the 10% tax on your insurance. Now, forget about inheritance tax. That's a different story. So next week, we're going to talk about trust. And if you have any questions regards anything to do with insurance, please call me. My number is there and my company that I work for is there as well. My email address is there as well. So until then, take care of yourselves. God love you and God bless you.